welcome you guys back to Tax One. We're going to get started today. We're going to pick up where we left off with the topic of employee benefits. So this is a part of Chapter 3. We're talking about employment income. And we had a big discussion last class about employee versus self-employed. We have to make sure that we can correctly assess the source of an income. Once we assess the source of an income, we can follow the proper rules for that source. So if we have assessed that an individual is an employee, then we will follow the appropriate rules for what types of income from employment would be included, including fringe benefits and things like that we're going to talk about here today, as well as what things they may be able to deduct from their income. So before we get started, quick housekeeping notes. I just posted the solution for assignment number 1. So that is now available there for you on Brightspace. If you haven't already seen a notification about that, if you have your notifications turned on, or if you use the app on your phone, whenever any new content comes up, you'll see that update. So assignment number 1 solution is online. The grading is almost done. Those grades will be posted shortly. So if you haven't got your grade yet, hold tight. Your grade for assignment number 1 will be up soon. But in the meantime, you can have a look at the correct solutions. If anybody has any questions about assignment number 1, please let me know. Assignment number 2 is also up and ready to go as far as the questions. So that's on chapter 3 and 4. So that includes the material here that we're working on for chapter 3. So let's hop back into chapter 3. Unless anybody has any questions or concerns you want to raise right now. All right, let's dive right back into it. So income from employment, everybody's pretty familiar with getting a salary or an hourly wage, but we can also have other benefits. So employee benefits, the slide here in front of you, benefits arise when an employer gives or pays something to an employee or a person related to the employee. So we can't avoid the tax by the benefit being given to, say, a spouse or something like that. Sometimes it can accrue back to the original person. So we can discuss that. So anytime an employer gives something, so this doesn't have to be money, right? It could be access to an asset, like, say, a vehicle, right? That sort of thing. So whenever they give or pay something to an employee or a related party. So what do we include in this category? Well, like I said, obviously salaries and wages, we're all used to that. That's your basic form of compensation, an hourly rate or a fixed annual salary. Maybe that you get bi-weekly, weekly, semi-monthly. But then we have our fringe benefits, the non-salary stuff. So what we want to watch out with this is that these benefits aren't being given by an employer in order to avoid tax. Often they're used for employee motivation. You've got a company car or whatever, just some extra niceties, but that is part of your compensation, and you do have to pay tax on that. So this is in Section 6 of the Act. It requires that any benefit received by an employee has to be included in their income. This one, so I'm just going to note here, right here is one where we're going to do some number crunching. automobile standby and operating cost benefit. So often an employer will provide a company vehicle. So this would be a vehicle owned by the company, by the business, but provided to the employee, excuse me, for their personal use and work use. We have specific ways to calculate what that benefit is worth for access to the asset as well as the usage of the asset. So we're going to talk about that. We've got a bunch of other things listed on here. You know, reimbursements and rewards. We'll talk about that. Sometimes it could be something that's small enough that we don't need to worry about it. And then other times, you know, basically we have to have something in there. You know, if everything was just, well, this is a gift for your 10-year anniversary of working for the company, but the gift is worth $50,000. Well, we can't do that to circumvent tax. That would still be a taxable benefit. So any benefit received by the employee needs to be included in income as the general rule. So this list here has some exceptions as well, things that wouldn't be. So it's not everything. There are some exceptions. So notable exceptions in this list here: private healthcare. So often you'll have a company provide a healthcare package to their employees. Sometimes you're having a deduction off your paycheck, right? Like maybe it's a 50-50 copay. You pay half of the healthcare premiums. Your employer pays half of the healthcare premiums. There can be different arrangements like that. Those healthcare premiums paid by your employee are an exclusion. Those are not taxable. So that's a good thing. You don't have to worry about that, and we can kind of get the healthcare covered through the employer. Excuse me. Now, that's for health insurance, private health care, you know, say a Blue Cross plan or something like that. Same thing for premiums on group disability insurance, assuming that the benefits will be taxable, which is normally what it would be. So no problem there. Pension plan contributions by your employer, right? Registered pension plan, that's RPP. Another one here, I'm just kind of picking and choosing. There's a lot on the list. You can look through them. Counseling. So your employer can provide, if they provide counseling, mental, physical health, that sort of thing. So there are certain things here that we're allowing to be excluded and not included in income. It can get a little dicey here with this insurance, health insurance, disability insurance. There are other types of insurance that an employer may pay for that would be taxable, most notably life insurance. So if an employer pays for your life insurance, that would be a taxable benefit. Specifically, the premiums on the life insurance. Life insurance itself, meaning you pass away, your beneficiaries receive the proceeds of a life insurance payout. In Canada, that life insurance is not taxable. But if your company pays for your premiums, that's taxable. So we take that as an example. So if we're talking about life insurance, the other option would be for you to go out and get your own life insurance, pay in every month, and then when you pass away, that plan would pay out to your beneficiaries tax-free, to your estate. So you had to earn taxable income to make the payment into the plan. Now, when you're receiving the proceeds, that's not taxable. You've paid into it yourself with after-tax dollars. In this case, it'd be your employer paying for it for you, just like they were paying for anything else. if they pay for your car, if they paid for, say, your house or whatever. Those things can be benefits. So in the case of life insurance, if your employer is paying for your life insurance for you, that's a benefit. When you get the life insurance proceeds payout, that will not be taxable. So the insurance stuff is a little bit scattered with the different types of insurance. So be careful with that one. So now on this here, we're back to inclusions. So this is what I was just talking about here, group term life insurance, right? So you've got that standard term life insurance. You just pay into it every month. If your employer is paying into it for you, then that's a taxable benefit. So we've talked about where, the big part of this is we are interpreting law, and when you have a scenario in front of you, it's, where do I go to find out the answer to this? So we have our legislative sources, right? So the actual Income Tax Act itself, that is the law. You have court cases to see the kind of common law, how these situations have been interpreted in the past successfully in court. And then you also have your non-legislative sources of information. So CRA, any of the documents and things CRA put out, they are not legislative, they are not law, but they do give you guidance on how CRA is going to interpret and how they're going to operate. So again, we want to be on the right side of the folks who are administering the tax law. That behooves us to do that, right? So those are, although not law, they are great tools for how to maneuver in this world of tax. So there's a slide here just kind of pointing you to the non-legislative sources that you would look at. Like CRA puts out an employer's guide. Everything in tax is self-reporting. So, a taxpayer is kind of expected to be able to report the income properly themselves. And that's a pretty big burden. So part of what CRA tries to do is to put their interpretations and their guidance and put that out to people so that they can properly prepare their taxes. Now, the reality is, in a complex tax system, people are going to need to come to advisors, such as myself, you guys, if you continue on in tax, to help navigate this complicated world. But CRA tries to put out all of this type of guidance. So we have an employer's guide for taxable benefits. We've got, they used to do, or they do these folios. That's on benefits and allowances received from employment. So there's some different guidance, and you can find all this stuff on the CRA website. So that is also a good source to see how they're going to interpret things and how they're going to operate. That stuff's all pretty easy to find. You just stick it into Google or go to the CRA website and plug it in. So that employer's guide is probably the best one. And you'll see some things in here. First off, automobile benefits. Boarding and lodging. Sometimes an employer will pay for a place for you to stay. If they pay for your phone and internet. Maybe they pay for your childcare. Discounts. How do we treat discounts on employer merchandise? Education, if they're paying for courses. Gifts, as I mentioned before, or awards, 10-year service award or some sort of a Christmas gift or something like that. So the employer's guide covers kind of all these topics and how to address them, all the different insurance, Sometimes an employer will loan money to an employee. Loyalty and other points programs. Meals, medical expenses, moving expenses. As a side note here, moving expenses, we're going to cover that in detail in Chapter 9. There's a specific way that we can deduct moving expense costs in certain scenarios. But also your employer may help provide to cover those costs. So that would reduce your deduction. But we'll get into those actual detailed calculations in Chapter 9. So it goes on and on here, a whole bunch of different, all of these items are all covered in that employer's guide. So this slide's just kind of going through, mentioning all these different things. So you can really kind of get into the weeds with all the little items. So what you might come across a specific thing, and then you need to kind of go look it up and go, what is the treatment for this? And make sure you've looked it up under the proper category. So when we're talking about employment benefits, that's a good resource. We talked last class that salary is taxed when paid. We talked about all this employer versus employee, and we talked about all of that stuff. Let's see here. Let's get into, so here's what we want to get into. So one of the spots in Chapter 3 where you can expect some questions where you have to crunch some numbers is under automobile. So very common for an employer to provide an automobile, or for, say a small business person who owns their own, closely held corporation, to have that corporation own the vehicle that they drive. So in that case, we have to calculate a benefit. And this is a category, I will note, that CRA loves to audit. So, because they can find money there almost every time. So they will do a payroll audit. So you have a CRA payroll account if you have employees. So if they come in to do a payroll audit, they will check this every time. So they will say, show us where you paid your employees, show us your payroll records. They'll tick and bop and check through all of that. But then ultimately they'll also say, well, hey, what vehicles do you have? Let me see your vehicle expense account, maybe. That's more of a corporate audit thing, but this could stem from a corporate audit too. But they'll say, what vehicles do you have? Who drives those vehicles? What vehicles are owned by the company, and who are they provided to? And what benefit have you calculated? How did you calculate it? What's it based off of? And a lot of times with a lot of small businesses, they think, this is a deduction for me. I can just stick my car in my company. I'll write it off. No problem. We're good to go. But that is creating a benefit. Why is there a benefit? There's a benefit because there is a personal component to the usage. Meaning, when you have a vehicle provided by your employer, it is next to impossible that you're not using that vehicle for some sort of personal use. Going to get groceries. I was going to the movies. Well, nobody's going to the movies here in Nova Scotia anymore, but you're going to go do things. You're going to go, especially pre-COVID, you're going out, you're doing something personal, you're leaving the house and going somewhere. But further to that, there's an even bigger item which ensures there is some personal use. CRA interprets that when you leave your house in the morning and you drive to your place of work, that is personal usage. The reason for that is because everyone wakes up in the morning, goes to work. Again, this stuff sounds a little silly in the world of COVID because a lot of people are working from home, but there are still people that are getting up and going to their office or going to their workplace, wherever that might be. That driving is considered personal. To the business owner, to a small business owner, that might not feel personal. They're saying, well, I'm going to work. That's business. But that doesn't count. So once that's off the table, you definitely have a significant component of personal driving every time you get up in the morning and go to work and then drive back home at the end of the day. So that piece is something that you kind of have to explain to clients so that they really understand, yeah, there is personal. Because what they might also say is, oh, yeah, that's my work truck. It's 100% business. Is it really 100% business? And we have to talk to them the same way they're going to get kind of grilled by the auditor, which is, show me that breakdown. So in order to support the usage, which is what this is all about, is your usage of the vehicle, technically speaking, you're supposed to keep a mileage log. So that mileage log would clearly state all the trips and drives. And if there is no mileage log, then we have to kind of figure out some sort of a reasonable estimation. Another thing with this employment and automobiles, right off the top, let's clarify. We have more than one potential scenario. So scenario number one is that you have this is the company owned, oops, I'm going to write with my old pen here, company owned vehicle. That could be owned or leased, but it's in the name of the company. In that case, when the vehicle's provided, then we have to crunch the numbers and we're going to do this standby charge operating cost benefit calculation we're going to look at in a moment. That's one scenario. The second scenario is that you're using your own personal vehicle for work. You're putting kilometers on your own vehicle and the company's reimbursing you. So that's scenario number two in relation to automobiles. So in here, it's a personal vehicle. Then, in addition to that, is really kind of 2A and 2B. Oh, there's 2B. You could also have deductions for using that employee-owned or personal vehicle. So when you're looking at a question or a scenario that's given to you, make sure that you understand what's happening in the scenario. If it's a personally owned vehicle, you don't calculate standby charge operating cost benefit. That's not what we're doing. That's for a company-owned vehicle. If it's a personal vehicle being used for work and an allowance is being paid, then we treat this a different way with possible income and deductions, or maybe just a reimbursed expense. And so we'll kind of talk about that. But there's two different scenarios here. So let's start with scenario number one, the employer supplied automobile. So in this case, we're going to cover the fixed costs with a standby charge. So this is for your access to the vehicle. You have it. So there's a fixed flat, you could go out to the car lot, you could buy a vehicle, you could set it in your driveway and never get in it. Well, you're still going to have to make that monthly, bi-weekly, weekly, whatever it is, payment. Just the fact you're not using it doesn't mean it doesn't still have a value or a cost. So the fixed cost, standby charge, that's for access to the vehicle. Your employer has given you the vehicle. Then the second component is going to be a variable cost, an operating cost benefit. This one is for the usage. How much did you drive it? And what's the breakdown? I'm going to say like work or business versus personal. So we have these different components. A, I'll call them A, B, and the last one C. Any amounts reduced by employee payments. So if you front some cash to your employer for that vehicle, you know, if they say, we're going to buy you a vehicle, it's going to be in our name, we're going to let you have it, we're going to pay all the costs related to it, but we want you to, you know, we're going to take a deduction off your pay for $100 a week or something. Well, that would offset the benefit. You have funded some of it as well. So those would be the three components to calculate your taxable benefit on an employer-supplied automobile. So that is one of our scenarios. Your work gives you the car, and these are the three components to how we're going to calculate it. So it's a good little number crunching question. The first thing we need to figure out when we're doing these questions is the usage. So we need those mileage logs. We need that breakdown. In this course, you'll be given those data points. So we have here a scenario where we calculate under less than 50% employment use, and a calculation, So we have less than 50% employment usage. Here's the calculation. We have 50% or more, and we're going to make an alteration to that calculation. So the phrase primarily means 50% or more. The main usage of the vehicle, or the majority usage of the vehicle, is for employment purposes. So that's what we're getting at here. We're trying to find out, is this just a perk, or do you need this for work? Some employees, if you were, maybe some sort of a regional manager and you had to travel to multiple locations all the time, you were in the car driving all around, say, the Atlantic provinces all the time, then that would be high business usage. Or if you were a salesperson or something like that, again, this stuff is this usage of vehicles is certainly going to be different in 2020 when we talk about during COVID. When I have clients come to me this year for their taxes and we're looking at their business usage, it'll depend on their industry and what's going on. Many of them should logically have a change if they were working from home instead or something like that. Is definitely going to decrease that. Other people, things never changed. Maybe in construction or something like that, never changed. So step one, find out the usage. That will determine which formula you're going to use. Step two, determine if it's a lease or owned. And depending on if it's owned or a lease, then you have a bit of a different calculation to make. So if we look at a scenario where the employee uses the vehicle less than 50% for employment, and the employer owns the vehicle, then we're going to go ahead and use this formula. So just read the question and follow through with what is the scenario to make sure you use the right part of this formula. So it's going to be 2% times the cost of the car times the months of availability. When we say availability, it's available days divided by 30 and rounded to the whole number. If it's a lease, we do 2/3 of the lease payments for the year. We do not include insurance if it's included. Insurance is not always included in a lease payment, but if it is by chance, then you have to exclude that. It's specifically the lease payment. We do include GST, HST, PST. So, our federal sales tax, our blended sales tax, or our provincial sales tax. Those numbers are included in this calculation because you would have to pay, if you were paying a lease as an individual, you would have to pay the HST as well. So that becomes part of the benefit. So it's the lease payment, including HST, that you would pump into there. We then have a standby charge reduction. If you are using the vehicle primarily 50% or more for employment. In that case, what we do is we simply take the regular charge and multiply it by this factor. All right, so we have a special factor here to multiply by as a reduction if we're at 50% or more. What that means is if this is mostly a vehicle for employment usage, we're going to cut you a break. CRA is going to cut you a break on the calculation of this benefit. So this calculation is non-employment kilometers divided by, and this is a fixed figure, 1,667 kilometers for month of availability. In this, so this we'll go through an example and try to make a little bit of sense out of this with actual numbers. Another note is that the numerator cannot exceed this 1,667. So what that means is this is a reduction. We're taking our benefit as calculated on the previous page, and we're multiplying it by something. That number has to be, what do I do here? Less than or equal to 1. If it was more than 1, we'd actually be increasing, or really it ultimately should be, if it's 1, it's not going to change it, right? So we want to be less than or equal to 1. If it was more than 1, we'd actually be increasing the standby charge. So we do not want to increase the standby charge in the case where the usage is primarily for employment. So we always want to first, at the start of a question, figure out the usage so that we know which direction to go. So you might be given the numbers and you just need to do the quick math to know the percentage. There, Danielle's question in the chat. So Danielle has asked, does this relate to a transport truck as well, or would that be different? So we a couple slides ago here, so we're talking here about benefits that would be provided. You could also, so there's a company provided vehicle, you could also bring your own vehicle. And those are kind of two scenarios. But we do have the, maybe we could say, third scenario, which is a vehicle that is truly, I'm just trying to think what the best way to what to call it here, but for sake of simplicity here, I'm going to just call this for now a business vehicle. Now, this is where this gets dicey and gray. What I'm talking about with this third, with a let's call it an all business vehicle, meaning the example that Danielle gives, a transport truck. So if you've got like, say, an 18-wheeler and you're hauling goods with it, well, that's a whole different scenario, right? You're not going to have to claim a personal benefit for that 18-wheeler. You know, nobody is, I mean, sure, you could drive that to the movie theater, you could drive that to the grocery store, but that's just not something that's on the radar. So those vehicles where it's a very clear purpose would be treated differently. So you can have, a company could have, say, 10 delivery vans or something, and those are carrying goods that are being sold, and those would just be a deduction for the company and not necessarily a concern. But you would have to look at each individual scenario. In the case of like a transport truck, it'd be pretty straightforward that was clearly just a deductible expense for the company. But as with everything here with tax, you can get into some gray area. If it's a delivery truck, well, yeah, the plain old white van or something, somebody could be driving that around on the weekends too. So, but those kind of vehicles, when you get into a truck, a lot of people drive trucks for fashion, for personal use, for whatever, but they might also use the truck on the job site. So there's just because it's a truck doesn't mean you're going to be able to deduct 100% of the cost. And there are many different types of trucks. So we can get into the weeds with this. I won't go too far down this path in this course, but we do have the correct titling of this is that we have what we would call a motor vehicle. Whoop. Sorry for that scribbling. Geez, I can barely write here. Motor vehicle. You'll have to imagine that word says vehicle. So motor vehicle, and we have a passenger vehicle. That is where the great divide is there. There are charts and things we can look at that classify what that is, but it depends on multiple things: the usage of the vehicle, the exact style and type of vehicle. So this gets into, it can get into a really gray area when you're talking about a truck, just say a half-ton truck or something. In that case, it's what is it being used for? How many seats does it have? If this is simply a two-seater and then a truck bed, and the usage is to haul gear to a job site, then we can look at that vehicle different than, say, an extended cab with lots of extra passenger space that is being used for more personal purposes, right? So it's that kind of thing. So we end up getting into the weeds. You guys aren't going to have to go that far down the path in this course. We're introducing these topics and getting into some of the basics, but it can get a little more convoluted for sure. Danielle says, for primarily business use, a taxi driver would be a good example of this. Yeah. So, I mean, I would say, for cab drivers, kind of an interesting one, because often they are self-employed and they are using they're providing the vehicle, right? So in that case, they may be reporting self-employed income and claiming deductions. So they probably they're probably not being provided the vehicle, so therefore there'd be no benefit. It's them using a personal vehicle for the work, so we'd be calculating the deduction. So that's kind of like 2A and B, where you're deducting the costs of using your own vehicle. I think that's, I'm not heavily familiar with the taxi industry, but I believe that they bring their own vehicle. So what does claiming deductions mean? Okay, so if we take one step back, on this slide that I scribbled all over here, we have scenario number 1, which is the employer provides the vehicle. When the employer provides the vehicle, then we're possibly going to have to report some income. We'll run those calculations. In scenario number 2 here, the employee or the worker provided the vehicle. When you provide your own vehicle, then it's potential that you can, if you're providing your own vehicle and using it for work, there's a potential you can deduct costs related to that. What deducting means is claiming the expense and reducing your income. So if you made $100,000, but you had to incur personal costs of $10,000, then your taxable income would become, or your net income for tax would become $90,000. $100,000 minus the $10,000 of deductions. Now, for an employee, deductions are pretty limited. We will look at that in Chapter 3, what deductions you could claim, but it's very limited for an employee. Once you get to self-employed, it opens up a much wider window for expenses to be deducted. So deduction just means reducing your income. And that's the number one thing we want for reducing tax is a lower income, right? That's where this all starts. We take our income and we multiply it by a bunch of tax brackets. The lower we can be on that stack of tax brackets, the better off we're going to be. So deductions are our number one way to reduce tax. Claim all reasonable deductions. So you'll notice this word is reduction. That's a different thing. This is just a calculation to reduce this. Deduction, when we're saying deduction, generally speaking in tax, that means reducing your income right off the top. So part one, so for an employer-owned vehicle, part one was the standby charge. Part two is the operating cost. So the standby charge was what you get added to your income for just having that vehicle sitting in your driveway at home. The operating cost is around your usage specifically. And this is a set rate each year. For all the questions we're doing, we're going to be calculating things for 2020. So the rate for 2020 is 28 cents per kilometer of non-employment usage. So in other words, personal. This is in the scenario where less than 50% is employment usage. So again, the first thing you need to assess in one of these questions is what is the percentage of the usage, and then follow from there. So if you have less than 50% employment usage, then you're going to calculate 28 cents for every kilometer of personal usage. If you are primarily using the vehicle for employment, so that means greater than or equal to 50%, That is the word primarily. Then you have an option. You can skip this 28 cents and instead just use 1/2 of the previously calculated standby charge. You can do that if you're primarily using the vehicle for employment usage. That's an option, by the way. So when we get to this part of the question, you want to calculate both and pick the one that's lower. So you will be expected in the question to earn all the points to calculate both. Calculate both and choose the lowest, right? We want to pay the least tax. We're talking about adding a benefit, adding income to your tax return. So calculate both options and choose the lowest if it's primarily for employment. If it's less than 50%, it doesn't matter. You just do 20. It's as simple as that. 28 cents times the kilometers. So the math is not really difficult. These calculations are fairly simple math-wise, but there's a little bit of choose your own adventure here. If this, go there, pick which way to go, select the lower. So you have to do a little bit of just understanding how the calculations work, how that path goes. But the actual number crunching is pretty straightforward once you know where you're going. So keeping records is important. This is just kind of some tax planning. I just want to highlight there, keeping records, if you want to be able, you need to be able to support that usage. So if you don't want to have to get into a debate with CRA, if you want it to be evidenced clearly, supported, because you have to support those kilometers, how they've been driven. It's much easier if you keep that mileage log. It's a pain in the butt to do it, but if you keep that mileage log, then you have the evidence to support for them upon audit. So why don't we, I'm not going to worry too much about this slide right now. Let's go, now that we've talked about scenario number 1, which is the employer provides the vehicle, and we have to calculate the benefit. Let's have a peek at a sample question here to kind of just quickly run through those calculations. So remembering there are multiple scenarios though. This is one scenario. The employer owns the vehicle, provides it to their employee. We can also have the employee owning the vehicle and using it, and we'll talk about those next. But this is strictly the employer owning the vehicle and providing it to the employee. That's when we do these calculations. Let's see here. There we go. We've got one here. So let's calculate some of this here. So the first one, the question is assignment problem 3-5. We'll have a look at that in a moment. Yeah, that's the one. And we'll calculate a couple scenarios. Oh, I got the actual physical text here with me today. So let's see. So 3-5 is at the top of page 131. So in this question, we've got a company called Kaplan Limited. It says the policy for Kaplan Limited is to provide automobiles to 4 of their senior executives. So the cars may be used for both employment as well as personal. So they're allowed to use these vehicles for personal as well as for work. It says when it's not being used by the employee, the company requires the cars to be returned to the company's garage. So if the employee is using it, they can keep it at home or do whatever with it. When they're done with it, it's returned. For 2020, the details regarding the use of the cars is as follows. So we've got 4 different senior executives. We have Bambi, Sheldon, Melissa, and Jerome. And they each have different vehicles and different scenarios. So let's start out with Bambi. So Bambi is provided with a BMW 300 series. The company leases this vehicle for $650 per month. This amount does include some insurance, $110 per month for insurance. She drives a total of 57,000 kilometers. I get out my calculator here. So she drives a total of 57,000 kilometers. 21,000 is employment related. So 21,000 of employment kilometers out of 57,000. So the very first thing I would do in this question, so that I know which direction I'm going, is I would take the 21,000 and divide it by 57,000. And I just did that, gives me, I'll round it, rounds to 37,000, or sorry, 37%. So that is the employment related usage is at 37%. So we know that we are less than 50. So there's going to be no reduction in the standby. And that alternate calculation for operating cost cannot be used. So we know that right off the bat. So we're just, because we are less than 50, we're going to go ahead and just do the straight calculations. So for standby charge, when you have a lease, this is going to be our formula here. So the 2/3 is just a fixed amount. Let's read a little bit more about her here. It says operating costs, all of which were paid by the company, totaled $11,300. Because of her extensive personal use of the vehicle, Bambi pays the company $200 per month. So there's a couple things going on there. It mentions that the operating costs were paid by the company. It does matter that the operating costs were paid by the company, because if the operating costs were paid by Bambi, then it would be a reduction. So Bambi has paid $200 per month. So the $200 per month that Bambi pays is reduced right here. So that's a negative. We're subtracting from the total because she paid out of her own pocket towards the expenses. The fact that there's $11,300 of expenses is irrelevant for purposes of this calculation. So the actual operating cost amount doesn't matter because we do a calculation of the benefit. Like we have a rate. It doesn't matter what the actual cost is. That cost would be deducted by the company. Fine. They do need to keep track of it. But for this purpose, we're not worried. We're only worried about what Bambee reimburses the company. So that's one component. That's a reduction in this calculation. The operating cost benefit is going to be strictly the personal kilometers times 28, because we could not do any kind of a reduction or other options with this one because we're less than 50%. We're only 37%. So we're just going to take those straight kilometers. So we know it's 57,000 in total. 21,000 was for work. So she was doing 36,000 kilometers for personal. So she has to claim a personal tax benefit of those 36,000 kilometers by 28 cents a kilometer. So that is worth to her $10,080 of personal benefit, which she needs to pay tax on. The standby charge, well, she had access to this. Basically, the 2/3 is just in the calculation. 12 months is because she had access to the vehicle for the whole year. And then multiplied by the payment, but we had to subtract out the insurance. That's not always going to be the case. If there is no insurance involved in the lease payment, you don't have to do anything. When there's insurance involved, take it out. We just want the raw lease payment, HST or GST included. Now, HST and GST is not mentioned here in the question, but if it was, you want to make sure it's included. That's part of the benefit. So that gives us our standby charge benefit. We add all of these together, and she has a total benefit of $12,000. So let's take a quick step back. What are we doing here? We have an employer who has provided a vehicle to their employee. The employer is paying for it. All those costs that are mentioned, right? All those fixed payments, all the operating costs, the gas, the repairs, the employer is taking care of all of that. They will deduct that on their corporate taxes or whatever. For the employee, you have just received a benefit. You didn't have to pay for the car. That is a taxable benefit, and it has to be reported. It is the responsibility of the employer to report that income, to put it on your T4 slip, to calculate it and put it on your T4 slip. You don't have to calculate this as an employee. However, you are responsible to pay tax on that income. So if your employer forgets to report it, say for 3 years, and then they get audited, and then CRA calculates it for them, that's going to get put on your T4, and you're going to have to pay tax on it. So you can't, play dumb. I didn't know. If you're getting a company vehicle, that is a taxable benefit. There should be an amount of money on your tax return for that. That is income. If we didn't have rules like this, then nobody would ever get paid a paycheck. Their employer would just pay for all their living expenses, right? It'd be that easy. We can avoid tax by just paying for things for you instead of paying you directly. So anytime an employer pays for something for an employee, that is potentially a taxable scenario. There are exceptions. We talked about, your healthcare. An employer can pay towards your, say, Blue Cross health plan, and that would be taxable. But if they pay for your vehicle, that is taxable. Most things your employer does pay for are going to be taxable. So it's their responsibility to report it, but it's your responsibility to pay tax on it. So ultimately, and I've seen this where, an employer didn't do this correctly, and then a bunch of employees, kind of get hung out to dry because they get 3 years worth of tax reassessments and now they owe. So if you learn anything from this class today, if your employer ever provides a vehicle to you for personal usage, then you should make sure that there's a tax benefit on your T4 and you pay the taxes. Otherwise, that could come back around on you. Let's look at another example here. So for Mr. Sheldon Captain, he has a Lexus GS. The company is, this is also a lease, $1,100 per month. In this case, there's no insurance, so we don't have to worry about insurance. It says during the current year, he drives a total of 34,300 kilometers, of which 32,600 are employment. So 32,600 divided by 34,300. I mean, we could eyeball this calculation, but just for fun, I'm doing it. So he is 95. Whoops. He is 95% employment usage. So he's on the extreme end that this vehicle, there's really not much personal usage on it at all. So with the higher employment usage will come a much lower total benefit. So somebody at 95%, you're going to expect a small benefit. Somebody at a lower like 37, you're going to expect a higher benefit like 12,000. So this is all because, if this person had to go get their own car to do this, then they would have to pay that out of after-tax dollars. So this is a taxable benefit. So let's look at Sheldon. So the operating charge is going to be the 2/3. We are going to just use the lease payment. There's no insurance to worry about. But what about this 8? Well, it says at the very end, it says that the car is available to Sheldon for 8 months during the current year. So we're not going to charge him for a full 12 months like we did up above. He only had it for 8 months. So we're going to assess to him 2/3 of the lease payment for the months that he did the lease payment. This is the monthly lease payment. That's why it's just simply 2/3, how many months you've got it, times the lease payment. That's it. It's that simple. Now, he is at more than 50% for employment purposes. So that means he can claim the reduction. How do we do the reduction? Right? This right here is our calculation for that. This 1,667 is a fixed number of kilometers per month. So in this case, it's 1,667 times 8. If it was 12 months, the most that figure can be is 12 times 1,667, which is going to be 20,004. So a base total kilometers of 20,000, if you had 20,004 to be exact, if you have it for the whole year. So it's kind of thinking an average general number of use. Now, the 1,700 in here is our personal kilometers, right? So that's simply 34,300 minus 32,600. So I don't think it shows that here in the calculations, but that 1,700, that is the personal usage. So you just simply do the math. 34,300 minus 32,600. 300 minus 32,600. That's how we got that number. That's all. So it's the personal use. You're going to reduce it by this factor, the personal usage divided by this fixed number. Let me do a quick thing here. This is a fixed figure, but you're going to multiply it by however many months. This is a fixed figure. It's always 2/3. And we're doing the reduction because we're at 95, which is more than 50. So we've factored in the reduction, and we're going to get 748 for the standby portion of our calculation. The operating cost benefit. Now, here's where we have to look at two different options. Two different options and pick the lesser of. So don't do this math in your head. Show your work. Show all of your detailed work. When you have different options to choose from in tax, calculate out all the options and show me that you've chosen one of them. So we calculated both of these. That's earning points. And then we accurately choose the lowest one. So in this case, it would be his $1,700 of personal multiplied by 28 cents. That's also a fixed rate for the year 2020. Or 1/2 of the standby charge. So he has the option to do 1/2 of the standby charge here. If that's lower, go for it. So we did, and then we get the total amount. If we look at the next, and you guys can work through these other questions, we've got a couple other scenarios. With Melissa Kaplan, this is an owned vehicle. So now we're doing 2% times the month times the total cost of the vehicle. So it's just a little different calculation because this is owned. So that's the owned vehicle example. Here, we were at less than 50%. So we couldn't, so no reduction, cannot reduce, cannot do the 1/2, can't do any of that. So this is a straight calculation. Personal kilometers times 28 cents. 2% times the number of months available times the cost. That's it, straightforward. Then the last one we have is Mr. Jerome Kaplan. And the trick on this one, so this guy is also, this was an owned vehicle. So 2% times this, in this case, he was eligible for the reduction, right? We looked at him. He had drove 93,000 kilometers and 24,000 involved personal travel. So be careful when you're doing these questions. It might tell you the personal travel and you have to calculate the employment. Or it might tell you the employment and you have to calculate the personal. So make sure you keep clear on what number they've given you. So if his personal travel is 24 out of 93, then 69 is going to be his business. 69 over 93 is 74%. So he's at 74%. So he is eligible for the reduction. But remember, this reduction is a reduction. So it can't be more than 1. Whoops. Numerator cannot exceed denominator. In other words, it only caps out at 1. It's not supposed to make the standby charge higher. It's supposed to reduce it. In certain scenarios, it will not reduce it. And that is going to be based off of your raw calculations. This guy has really high usage. So if you take his, what did he have here for total? So he had 93,000 kilometers in total. He had 24,000 personal travel kilometers. That is more, right? So he had 24,000. That is even more than the 20,000 that you'd have in that calculation. 1,667, right? The fixed, sorry, the 1,6670 divided by 12 is Oops, no, let me go up. I'll show you the one we were looking at there before. This one here, right? The 1667. If you take 1667 and multiply by 12, that's 20,000. So in this case here, he only had it for 10 months, I believe. Yeah, only had it for 10 months. So he's only 10 times the 1667. So that's his denominator. And he clearly had 24,000 kilometers, which is more than the 16. Even if he had had it for 12 months, and then it would have been 20, he would have had 24, so he would have been over. So this is the little trick to this one. I see we're at 9:46. So just to wrap up, that watch for that, it cannot exceed 1. The reason why this would happen, that you would cap out at 1, is because your kilometers are more than whatever that base is. So if you had it for 12 months, that would be 20. In this case, it's 10, so it's 16. But for him, it was 24. He's well over that, so it caps out. So even though he's at 74% and would be eligible to reduce the standby, it's not actually going to get reduced because of the math, because he has such a high, just raw number of personal kilometers, then he doesn't get to do the reduction. That's what it all boils down to. Even though his percentage is high, he just has such a high raw number, meaning more than 1,667 per month. And then after that, you do the operating. This is the last part to this question. The operating cost benefit, you calculate both of them because he's at 74, 50 or more, so he would qualify to pick. Well, look at this. Half of his standby charge is actually higher than the normal 28 cents calculation on 24. So he also has a little bit of a weird scenario there. So this is too high, so we're not going to pick it. We're going to pick, this should actually be over here, the 6720. We get to choose here the lesser of. So it's not always going to be the half standby. In this case, his standby is pretty high, and the way these numbers just crunch out, that's the one we pick. So that is it for today. Thank you for your attention, folks. We will, when we come back next class, we'll still talk a little bit more about Chapter 3 before we get into Chapter 4. We will talk about the other scenarios. This number crunching is employer-owned vehicle provided to the employee. We'll talk next class about when the employee brings the vehicle.